Welcome to Value Creation Live. Darrell Amy here, and I'm excited to share with you a very important topic, especially as this is being recorded right here at the beginning of the new year. I want to talk with you about the most important goal every business owner should set. Look, this is a time of year when we set goals. We're setting goals in every area of life. Hopefully, you're setting some personal goals, you're setting business goals as well. I want to talk to you today, though, about one of the most overlooked and perhaps the most important goal you can and should be setting for your business. And this is a very, very timely time to have this conversation about the most important goals you should set for your business. There's a number of different types of goals for your business. I call these level 1, level 2, and level 3 goals. Level 1 goals for your business are around revenue. They're saying, hey, this is my goal for revenue for this new year. We want to, move from this to this. We want to go from 10 to 15. We want to go from 30 to 45 million, whatever your number is. A lot of businesses start by setting goals around revenue. But as you begin to grow as a business and mature, you begin to realize it's not about how much money we bring in. It's also about how much money we keep. And so another way to set goals is at the level of profit. And we've spoken about this in previous editions of Value Creation Live. We've said, hey, we need to make sure we're driving profit in our business. And we need an understanding of not only the dollars of profit, but actually the margin that we're bringing to the bottom line. We'll talk more about that as we move to setting our third goal, which is enterprise value. A level 3 goal for a business owner is setting a goal for enterprise value. Because at the end of the day, we're building a business to have an asset. And the more valuable that asset, the better things are going to go when it comes time to transition out of that business, whether it's to transition to the next generation, to sell the business to a third party, or even sell the business to something like an employee stock ownership plan. Whatever the exit strategy is, we want to make sure that when we get there, the company is at the maximum value, the value that we need it to be. And if we don't set goals, we've all heard that line that said, you're going to miss 100% of the goals that you don't set. And there's nothing in a lot of ways that's more important after a career, after years and even decades of building a business, to get there and realize that I didn't have a goal for the most important transaction in my life, which is going to be the sale of a business or the transfer of the business. So we need to have goals around enterprise value. And I want to talk today about setting those goals. From a personal perspective, it begins with an understanding of your own personal numbers. For our friends that are listening in, and I mainly work with privately held businesses. So there is what I need to know as a business owner is, first of all, I need to know what I need to get out of my business. We're going to talk about 2 goals for the value of your company. One is kind of the minimum, is what you need to get. And then we'll talk about a stretch goal. How do you set the minimum goal? Well, this is a conversation with your financial advisor who will talk about your wealth gap. And basically, it's a simple conversation on one level of saying, hey, this is how much you're going to need to be financially independent, maybe to retire, if you want to use that word. You're going to need this much in investable assets. You've currently got this much. This is how much you need from the sale of your business. Pretty simple. Once I know that number, though, and this is why I want to bring this up, once I know what my wealth gap is, I can then understand what I need to get out of my business. So let's say to my minimum to retire, I want to be able to pull $500,000 a year in income from my assets. If I have them invested at 5%, let's see, that's $10 million I need to get invested, pulling 5% to get $500,000 a year. Let's say I have $2 million in invested assets already. That means I need to get $8 million from the sale of my business. That's what I need to clear after tax. Now, there's one more question I got to ask, and that is, what's the business worth right now? What's it worth right now, today? Here, as you're listening to this, do you know the answer to the question, what would your business sell for right now? And I mean a real answer, not an answer that you heard on the 17th green from someone that was bragging about selling their business. That's about as reliable as someone talking to you about what size fish they actually caught, not something that you may have overheard at the bar at an industry event. I'm talking about a real understanding of the current market value of your business. And then you can understand the math on that of what your business needs to be worth for you to hit your minimum target. I call that your minimum value goal. That's the goal that in not just the back of your mind, it's written down that you say, I've got to get my business to this level in order to be able to reach financial freedom. At that point, are you going to cash out? Maybe, maybe not. But you need to know from a minimum standpoint what the minimum value of your business needs to be. How do you calculate that? Well, sit down with your financial advisor, come up with your plan, and then understand the value of your business, what it is currently and what it needs to be. You'll have your minimum value goal. But as entrepreneurs, as business owners, we didn't just get in this to hit the minimum. I also want to know what my stretch goal is. But here's the problem with the stretch goal. If I just go, hey, my stretch goal is for my business to be worth $500 million. Okay, well, that's great. But I want to make sure my goals are realistic. How do we come up with realistic stretch goals? In my first book, Revenue Growth Engine, we talked about goals that were aggressive but realistic. How do we come up with aggressive but realistic goals for enterprise value? Well, the answer to that is we need to look at what drives value, and this is going to give us some clarity. So there's two things that drive the value of your business. EBITDA, how much are you bringing to the bottom line? What's the cash flow off that business that an investor would expect? And then multiple. If EBITDA measures the quantity of your profit, multiple is going to measure the quality of your profit. So let's talk about both of those. EBITDA. Well, what's your profit margin? There's a range of profit margin. Every business has a bottom line profit margin. I'm not talking about the dollars here. I'm actually talking about the percent. What is your profit margin? And then the question you've also got to be able to answer, and this is a question we answer when we're doing evaluation for a company. We'll dig in and research on that industry, and we'll find out what the best in class profit margin is. So let's say right now, I was just looking at a transaction today. The deal sold at the margin of the company that sold was 4.1%. Best in class for that particular industry that I was doing research in was 12%. Well, guess what? They left 8% margin on the table in potential. What if that company had have done the work leading up to the sale to maximize the profit margin, and they'd gone from 4% to the industry best in class at 12%? Well, just do the math. That'd be 3 times the profit. They would have got 3 times the value out of that company just based on the top half, but also the quality. Now, the more profitable a company, what do you think that's going to mean from a buyer's perspective about the value of that company? Well, a company that's running 4% margin versus a company that's running 12% margin, a buyer's going to look at that 12% margin and go, hey, not only is there more margin, I feel more comfortable about the quality of this. So how we determine the best in class value is simple. It's understanding the best in class profit margin and the best in class multiple. So let's say the best in class, let's run a real example on this. Let's say we've got a company here currently. Let's go full screen on this. We can read it. So if you're listening in, I'll read through this. And by the way, if you're listening in, you may want to check us out on YouTube so you can watch some of these examples. But let's take a look at this company here. They've got a $10 million company. They're running a 4% profit margin, which means their net profit is $400,000. And let's say their industry multiple range is 4 to 8. But when we look at that company and assess it, we go, well, you know what? Based on the readiness of that company to sell and how attractive it is to a potential buyer, we're going to score it a 4x on that. So I got 400,000 times 4. That company's worth 1.6 million. But let's also say we did our research and we found out that best in class for that company is 13% margin. Well, for those of you who are following along, 10 million times 13%, that would mean that same company, that company with the same amount of revenue is bringing 1.3 million to the bottom line. But let's also say they made their company ready to transfer. They've got everything lined up. It's not dependent on the owner. There's great processes in place. There's an amazing culture. It's an innovative company. And instead of trading at 4x, this company is able to trade at 8x earnings. So now we got 8x, 8 times 1.3. That's $10.4 million. What you notice here is you've got a company that's doing the exact same revenue, but instead of being worth 1.6 million, it's worth 10.4 million. I don't know about you, but that's a game-changing difference. What did that company have to do to become best in class? Well, they had to fix their margin problem. They had to figure out how to increase their margin, industry best in class. They also had to make their company more valuable on the range of value, meaning that it was more ready to transfer. The buyer looked at it and goes, this thing's ready to sell. It's ready to buy. And it's attractive. This is an amazing company. Well, they did the homework, and there's the difference, 1.6 to 10.4. That is a massive difference in value. Now, let's go to the far left and say this particular individual said, you know what? For me to hit my retirement income goal, I know I'm going to need at least 5 million after cash. And my stretch goal to like make this thing rock and roll, we'll talk about it in a minute. But now I go, okay, well, best in class, 10.4 million. We back some taxes out of that, or of course, work with our estate planner and financial advisor to create the most tax efficient sale possible. That's definitely going to cover that 5 million goal, I would say. And so we got a good scenario there. Currently, that person's not ready. They haven't hit their goal, but they know what their number is, that their minimum to get out and move forward in financial independence. Now, what's the stretch goal? How do we set that? Well, let's say we get best in class and we add some revenue growth on top of that. So let's go from 10 million to 20 million. Let's get that profit margin up to 13%, in this case, best in class. In this example, now this company's pulling 2.6 million to the bottom line. They're trading at a premium multiple for their industry. Now we got a company worth almost $21 million. So as an owner, I might look at this company and go, okay, my stretch goal here is $20 million. How are we going to get there? Well, over the next period of time, we're going to double our revenue and we're going to create a margin of 13%. And we're going to make sure this company is ready and attractive to a potential buyer. How does all this happen? This happens when we set goals. Now, think about this person that's sitting at 10 million. Let's just go back to this example. Let's say this person right now is sitting at 10 million. They're setting a goal and saying, we want to get to $12 million in revenue, but they don't do anything about margin. Well, if I keep the same margin, let's see, 12 million at 4%, I'm going to get 600,000 the bottom line. I added 400,000 to my value. Great, but it's not getting me anywhere near the minimum that I need. That same company that understands what their minimum goal is for value and their best in class value, look, that owner and that leadership team, they're probably going to make some very different decisions at the end of the year. They're probably going to make different decisions going forward in terms of how they run the company. So my question to you is, what are your goals? Do you have a goal? Do you understand your enterprise value goals? Do you know what the minimum value goal is to fill your wealth gap? Do you know where you are in terms of crossing the line and going, okay, well, I know this is worth enough to be financially independent, for me to be financially independent. No, my company is in a place where it's ready to sell and attractive enough to a buyer. Do you also understand your stretch goal? What could this be worth? And to me, once again, as an entrepreneur, the minimum goal is great, but what I really want to know is, what could this thing be worth? And once I'm able to see that and see it realistically, and what I mean by realistic is that other companies in my industry have done this. Now I know what my stretch goal is, and now I can create a plan to get where I want to go as a company. So as we wrap all this up, I really, really want to challenge you. If you're a business owner and you don't have value goals, I want to challenge you to fix that problem before Q1 is over in this new year. I want to ensure that you're set up for success. So what do we need to know? Well, I want you to know three things. First of all, what's the current value of the company? What is the current value of the company? If you've watched previous Value Creation Live, you've seen that the data on this is really, really scary. The reality is the majority of mid-market business owners have not had a market valuation done on their company in the last 12 months. And this is something that's really important for you to understand as a business owner. If you haven't been through the exercise of understanding the market value of your company, then you need to go through that exercise. And I'd be honored to lead you through that. If you want some guidance on that, by the way, just grab a copy of A Business Owner's Guide to Maximize Business Valuation. You can get that at book.valuecreationengines.com. But I need to know what the current value of my company is. I need to know what my minimum value goal is. And that's a conversation in partnership with your wealth advisor to be able to go, hey, what would it take for me to have financial freedom? Where am I right now in terms of my current assets? What do I need my business to be worth after all the dust settles after tax for me to have the financial freedom I want? Now you got your minimum value goal. And then the fun goal is, what is the stretch goal? What could this company be worth if it were best in class? If it were best in class in margins, if it were best in class in multiples. And when I'm able to understand that, now I'm able to set an aggressive but realistic stretch goal to understand what the company could be worth. And this is where I start to get excited, because it's one thing to have a minimum goal, and we all want to hit that. We all want to reach some place of financial independence, whether we're going to retire or whatever the next chapter of our life looks like. But at the same time, if you're going to get up in the morning and you're going to work and put in the time, the blood, the sweat, the tears, all the things we know as entrepreneurs it takes for our business to be successful, why don't we max this thing out? Because that's where generational impact begins to happen, where we know we got our minimum covered. Now we got gravy on top of that. Now we've got excess resources that we can be excessively generous with to fuel the next generation, to leave an impact, generosity to amazing organizations that are making the world a better place. All kinds of fun stuff begins to happen. And that begins to unlock when we understand what our company's worth now, what minimum it needs to be worth, and what it could be worth. If you don't know the answers to those questions, you need to know the answers to those questions. If you're a business owner listening in, you need to know the answers to these questions. If you're not a business owner and you're part of a leadership team, you need to know the answers to these questions, because as a company increases in value, it creates more opportunity, it creates more security, it creates more of everything. And we need to be managing to value. So if you don't know the answer to that question, find out the answer to that question. If you want some guidance on that, I welcome you to go to book.valuecreationengines.com, grab a copy of A Business Owner's Guide to Maximize Business Valuation. What you're going to like about this book, it's an airplane book. So it's not 500 pages long. It's actually 40 pages long. So you can work through this and get a great idea of what it takes to grow the value of your business. And as you do, if you want a conversation about the valuation of your business and what it would take to truly understand the numbers that we've talked about today, I'd be honored to have that conversation with you as well. Just go to valuecreationengines.com, click Get Started, and we'll find a time to have a confidential conversation. So thanks for joining me today for Value Creation Live. I wish you all the best as you're setting goals for the year to come. And I challenge you, make sure that the number one goal you set is around your enterprise value. As we always say, let's get going and let's get growing.
What's the true value of your business? For business owners of mid-market companies with $10 million to $100 million in revenue, this might be the most critical piece of data you can know. The answer to the question about the value of your business can vary widely based on how attractive your business is to potential buyers and how ready it is to transfer. At Value Creation Engines, we believe that increasing the value of your business is about more than just making money. It's about unlocking options. It's about creating the freedom to shape your future on your own terms. It's about harvesting assets to create a meaningful impact in your family and in the world. Knowing and growing the value of your business is not just about creating a successful sale or transition to the next generation. A business that has intentionally focused on value creation runs at peak performance, giving you the freedom to begin stepping back from day-to-day operations, freeing you to pursue new passions both inside and outside your company. Here's the challenge. Recent research by the Exit Planning Institute revealed that over 83% of businesses that start a sales process fail to complete the transaction. Only 17% of businesses that begin the process of selling are successful. For family-owned businesses planning for a generational transfer, the statistics are similar. Sadly, only 30% of generational transfers succeed. For the ones that do succeed in selling their business, 81% of them wish they had spent more time preparing. That's why smart business owners get on the front of this by creating a strategic exit plan as far as 5 to 7 years in advance, allowing them to accelerate company value as they prepare the company for a successful sale. At Value Creation Engines, we specialize in helping mid-market companies multiply their valuation so they can maximize their impact. Our proven frameworks, grounded in the principles from the Value Creation Engine, guide your journey to maximum value. Whether it's growing revenue, streamlining operations, building an entrepreneurial culture, or driving innovation, we're here to help. Our proven process begins by measuring your current business value through current industry multiple data and a thorough analysis of your business. Next, we collaborate with you, your financial advisor, and your leadership team to develop a value creation plan that aligns your personal and business goals. Then, we help you execute 90-day sprints designed to improve your value creation engines so you can maximize enterprise value and reduce risk. Every 90 days, we'll review your progress, adjust the plan, and evaluate if it's time to sell or keep growing. It's time to take control of your business's future. Unlock the full potential of your company and create more options for your next chapter. Schedule your 90-minute enterprise value meeting now. Discover the top ways to accelerate value and get the answers you need to minimize your risks and maximize your valuation.